What's up everyone, it's Cathie with Money Investing. So in this video, I wanted to go over Cathie Wood doubling down on her concerns of disinflation or deflation, so to speak. We'll talk a little bit about money supply. We'll talk about her concerns on the Federal Reserve's tightening or over tightening even further. Then I'm going to go over Tesla stock, a very brief overview of Tesla, going over my plan, and then also talk a little bit about a new ETF that I feel like there's additional opportunity with that, with respect to what we already talked about with XLF. So financial stocks obviously dropping quite a bit with Silicon Valley Bank collapsing. I do think there's going to be additional opportunity in another ETF as well. So as always, if you enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. And the link to our Discord and Patreon is going to be down below if you're interested in joining us. There's going to be limited spots available. And in fact, I also posted a brand new private only members video, which is going to be called A Wheel and a Ladder. And the reason for this video, and it's going to be uploaded very soon for all the members to watch, it's going to be going over our wheel strategy, which I'm going to be starting in April. So that's going to be mostly trading options and generating those premiums and that passive income. So if you want to follow along and be a part of that, of course, you can join our Patreon and our Discord. And the ladder is going to be for T-bills, which is going to be more about capital preservation and, of course, building out these bond ladders, T-bill ladders that's going to be maturing every month and allow us to generate some nice yield considering how high interest rates are. So make sure that you check that link out. There's only 4 spots left for Investor Early Bird. And after that, I will be closing that tier out for good, forever. And the discount's also going to go away for the annual after March. So this right here is going to be Cathie Wood's tweet from about 15 hours ago. She says U.S. demand deposits, which make up a vast majority of M2, have been falling since last August. And that's true. M2 has dropped. Money supply is down about 1.7, close to 2% on a year-over-year basis. And now we are seeing the consequences of the yield curve inversion that began last July, which I feared last September as described in the thread below. The inversion has worsened, and that's true. The inversion of the yield curve, the 10 and the 2, has worsened even more. It came down to negative 107, 108 basis points. I even did a video about this last week, talking about the inversion kind of steepening even more. She goes on by further saying that many banks parked the COVID stimulus gusher in long-term bonds at record low 1 to 2% interest rates, never expecting the Fed funds rate to surge at a record-breaking 19-fold to 4.75% in less than a year. Now, deposit outflows are forcing them to sell, quote, safe securities at losses. So again, as banks get these deposits, they put them in long-term treasury bonds at really low interest rates, 1 to 2%, right? So interest rates were pretty much not paying you that much at the time, which is exactly why I'm going after the T-bill ladder now, because interest rates are higher, right? And they're expected to stay higher for longer considering their battle with inflation. You definitely want to be taking advantage of this environment in a very strategic way. And that's exactly what I'm going to be doing in terms of asset allocation. And this is literally the opposite of what banks did back when interest rates were lower, right? They obviously didn't have any other option but to go long treasuries and mortgage-backed securities at record low interest rates. And because of how high interest rates have gone up, prices have dropped. So they're holding on to big losses on their books. And as a result, they had to sell, or they were at least forced to sell safe securities at losses because depositors started outflowing that cash. They wanted that cash available immediately because of higher interest rates, right? So it's kind of like a double-edged sword. She goes on by further saying that deposits are leaving banks to take advantage of higher yields in money market funds and other funds. At Silicon Valley Bank, and startups were responding to a drought in venture capital funding by draining deposits to fund their operations. And that's really true because of higher interest rates, because of the higher cash burn. A lot of the Silicon Valley Bank startups had to fund their operations by draining the deposits that they had in their banks. And as a result, Silicon Valley was kind of forced in this situation. And tonight, the FDIC announced that all depositors, both insured and uninsured, at SVB and Signature Bank will be made whole, while equity and bond holders are wiped out. Why? I wonder, will equity and bond investors remain loyal to regional banks? Now, this is quite an interesting take towards the end. Why would equity and bond investors remain loyal to regional banks? Because if you think about at the underlying problem of this entire situation was the fact that demands were outflowing at such a rapid rate, and Silicon Valley Bank did not have deposits available to them, okay, because they were invested in long duration bonds. So that was obviously one of the reasons why the stock dropped the way it did, and FDIC pretty much put it in receivership. But moving forward, when it comes to regional banks, and that's another thing that I wanted to address here very quickly. Let me just break that down in a separate screenshot. Hopefully I have that. Let me see. Next week, we've got the CPI and boom, right here. So this was something that I wanted to go over, which I think is going to be very, very interesting for us to also look at. So for example, in the US, small banks, those with less than $15.2 million in transaction accounts, have no minimum reserve requirement. So those are going to be a lot of your regional banks, small banks, medium banks, right? That don't do a lot of transaction volume. Banks with $15.2 million to $110 million in transaction accounts must hold 3% in reserve. Large bank, those with more than $110 million in transaction, and these are your big fours, Bank of America, JP Morgan, must hold 10% in reserve, right? For some cases, it's going to be even higher if they failed its stress test. So for example, Bank of America is over 11%, JP Morgan, Goldman Sachs, well over 12, 13%. And these reserves must be maintained in case depositors want to withdraw cash from their accounts. Banks may keep reserves in two ways. They can keep cash in their vault, or they can deposit their reserves into an account at their local Federal Reserve Bank. But the fact that regional banks don't have that requirement, that minimum reserve requirement, is one of the reasons why Silicon Valley Bank was in this trouble, right? They didn't have any reserves. Depositors came to withdraw money and they were forced to sell securities. Now, going back to what Cathie Wood said, she's right. If stocks and bond holders are actually wiped out, why would they trust other regional banks? That's exactly one of the reasons why we saw a significant drawback in KRE. So KRE is like a regional bank ETF, dropped over 12.3% despite the confidence or the stability from the government coming into the market. They're kind of restoring that confidence, but investors are still fearful. Investors are still fearful of the fact that regional banks are going to be in trouble if they don't have any reserve requirement, and if they are in a very similar situation than Silicon Valley Bank, and the fact that stockholders and bondholders are not going to be obviously compensated for that, and they shouldn't, right? That's the risk that they're taking on if the banks that they're investing in are not well equipped or do have reserve ratios. Then of course those banks are open to those challenges, open to vulnerabilities of potential drawbacks. However, I also do believe that with the government stepping in at the last minute and of course backstopping all uninsured and insured deposits, that this fear will blow over. I do think that this is very, very overblown to a point where even regional banks selling off represents an opportunity. XLF in particular selling off represents an opportunity. And I know it might sound scary at this point, thinking about going into financial stocks, like when all banks are collapsing, like there's so much stress in the banking sector. Yes, it may sound stupid. I get it. And I understand. I'm fully aware of that. But I also understand that this is a lot of fear, because had the government not stepped in, it would have been stupid. But the fact that government is stepping in, backstopping all insured and uninsured deposits, I think there's a lot of opportunity to be gained here, considering so much fear is driving this momentum lower, and we're just seeing a lot of downside. So XLF definitely going to be on my watch at $29.50. FAS is certainly going to be on my watch here at $53, $52. The lower it gets, the better. And another one to consider, KRE. This might have a little bit more of a risk because it's regional banks and not large big four. So regional banks, definitely there's more risk considered that they don't have any reserve requirements, and they're more likely to be something like Silicon Valley as opposed to some of the big four, Bank of America, JPM. They've got reserve requirements, they're well liquidated, very capitalized, so lesser risk on that side. But these are where opportunities, in my opinion, might be moving forward, and to take advantage of that. Now, Cathie Wood goes on by further saying, if the Fed continues to focus on lagging indicators like CPI and does not pivot in response to the deflationary forces telegraphed by the inverted yield curve, then the crisis will devour more regional banks and further centralize, if not nationalize, the U.S. banking system. As a result, and crypto team at ARK Invest are not surprised that Bitcoin and Ethereum appreciated and U.S. regional banks imploded. So, of course, crypto is doing a lot better than what we've expected before. It pretty much rallied quite a bit. But bottom line is, I do expect some opportunities in the financial sector, in the banking sector. And right now, regional bank ETF might be a little bit more risky than compared to the financial stock, but I do expect opportunities here. And I will be sharing some more updates and alerts with our members over in Discord. Now, finally, going over Tesla very, very quickly. And Tesla here getting a bit of a bounce back up from 166. I do still think that Tesla has maybe a little bit more downside. Wouldn't be surprised if it does come down to 150s here, considering the macro dynamics, macro environment that we're trading in. And of course, we've got inflation numbers coming out tomorrow. So I would still be careful. I'm going to be looking at cash secured puts on the next big red day. And the next big green day, I'll be looking at selling covered calls once again for Tesla, maybe at 230, 220, around those strikes for Tesla, considering the premiums are going to be good on a very strong green day for Tesla. So again, I'm bringing opportunities to you guys with Tesla. We'll be looking at trading options again, and with other opportunities. I do believe the financial sector, definitely under a lot of pressure, will represent opportunities considering how much fear there is. And of course, not to mention that we're going to be building out the T-bill ladder and the will strategy starting in April, which you can be a part of if you want to follow along. As always, happy investing. If you guys enjoyed this video, found it helpful, make sure that you drop a like, subscribe, and the link to our Discord and Patreon is going to be down below. Happy investing, and I'll see you all in the next video.